Dollar decline versus dollar collapse. Why a dollar decline is inevitable, while a collapse is unimaginable. When the dollar value is lower than other currencies in the foreign exchange market, the US dollar falls. The dollar index is falling. It also means that the euro to dollar conversion is higher due to strengthening of the euro and the ability to buy more dollars when the US currency weakens. The yen can also threaten the transport trade because the weak dollar often means a stronger yen. Declining dollars can also mean a decrease in the value of US treasuries. This increases Treasury returns and interest rates. Treasury bill returns are the main driving force of mortgage interest. This may mean that foreign central banks and sovereign wealth funds also hold less dollars. This reduces the demand for dollars. Effects: a weaker dollar buys less in foreign goods. This increases the price of imports, contributing to inflation. As the dollar weakens, investors in the benchmark 10-year Treasury and other bonds sell their dollar-denominated holdings. Oil and other foreign contracts are denominated in dollars. A weaker dollar will drive up their prices because the exporting countries need to maintain their profit margins. The value of the dollar is one of the three factors that determine oil prices. On the plus side, a weakening dollar helps US exports. Their goods will seem cheaper to foreigners. This boosts the US economic growth, which attracts foreign investors to US stocks. But if enough investors leave the dollar for other currencies, it could cause a dollar collapse. Causes: on July 1st, 2014, the Foreign Account Tax Compliance Act required foreign banks and other financial institutions to disclose information regarding income and assets held by US customers. Its goal is to root out wealthy US taxpayers who are hiding money offshore on purpose. It also wants to stop foreign banks from using tax evasion as a profitable line of business. Many were worried foreign banks will drop US customers to avoid compliance, thereby pushing them away from dollar-denominated assets. On October 16, 2013, China allowed British investors to pour $13.1 billion into its tightly restricted capital markets. This made London the first trading hub for the yuan outside of Asia. This is one way China is trying to encourage central banks to increase their holdings of the Chinese yuan. It is the biggest potential threat to the value of the dollar. China would like the yuan to replace the dollar as the world's reserve currency. Since then, China has been devaluing the yuan against the dollar. It is doing so because the world's third largest economy is worried its economy's growth is too slow. But the trouble is China would strengthen, not weaken, the dollar because the Chinese central bank buys dollars to keep it strong and the yuan weak. As a result, China has a large influence on the US dollar. The yield on the 10-year Treasury note hit its lowest point in 200 years on June 7, 2012. It indicated dollar strength as measured by treasuries. China's currency, the yuan, rose to 6,4167 against the dollar, a 17-year high on August 10, 2011. It showed further dollar weakness as a result of the debt ceiling crisis. Background: the dollar declined 40% between 2002 and 2008. This was in part of the $700 billion US current account deficit at the time. Over half of the current account deficit is owed to foreign countries and hedge funds. The dollar strengthened during the recession as investors sought a safe haven in comparison to other currencies. In March 2009, the dollar resumed its decline thanks to the now $25 trillion US debt. Credited nations like China and Japan worry the US government will not support the value of the dollar. Why not? A weaker dollar means the deficit will not cost the government as much to pay back. Creditors have been changing their assets to other currencies over time to stem their losses. Many fear this could turn into a run on the dollar that would erode the value of your US investments fast and drive inflation. 7 steps that will protect you from a declining dollar. There are 7 steps you can take to protect yourself from inflation and a dollar decline. First, increase your earning potential through education and training. If you earn more each year, you can outpace a dollar decline. Second, invest part of your portfolio in the stock market. Even though it's risky, the risk-adjusted returns often outpace inflation. The third, purchase Treasury inflated protected securities and serious bonds from the US Department of the Treasury. Those are the best ways to protect yourself from inflation. Fourth, purchase euros, yen, or other currencies which will increase in value if the dollar loses its power. You can either purchase them outright at a bank or buy an exchange-traded fund which tracks their values. Some experts recommend short-selling stocks of companies which will be hurt by a falling dollar, but that's not a good idea because you don't know which companies will be hurt the most. Furthermore, you don't know how fast the dollar will fall. If you did, you would be better off buying foreign currencies future contracts. You could use leverage to better reward yourself for the knowledge. If the dollar outright collapses, the devastation upon the world's economy is hard to imagine. No one knows what will happen, so you must be ready to move at a moment's notice. 5. Buy gold, precious metals, and shares in gold mining companies. If the dollar falls faster, prompting hyperinflation, then you would benefit. Number 6. If you're worried about it, then take this 6th step. Keep your assets liquid so you can buy and sell as needed. In this scenario, you should have as little as possible in real estate, gold, bullion, or other difficult to sell goods. Make sure you have skills that are needed everywhere, such as cooking, farming, or repairing. Get a passport in case you need to move to another country. Number 7. Make sure you have a well-diversified portfolio. Rebalance your asset allocation if it looks like the business cycle is going to shift. You can tell that by following key leading economic indicators. Bottom line, although the dollar has declined dramatically over the last 10 years, it has not yet collapsed. It's not in the best interest of most countries to allow this happen. A collapse would wipe out the value of their dollar holdings. Regardless of the outcome, be prepared. Most experts agree that the best hedge against risk is with a well-diversified investment portfolio. Ask your financial planner about including overseas funds. These are denominated in foreign currencies, which rise when the dollar falls. Focus on economies with strong domestic markets. Also, ask about commodities funds such as gold, silver, and oil, which increase when the dollar declines. Dear Daily News Report viewers, after watching this video, you can find previous videos by clicking on the top right button. We recommend watching, subscribing, and sharing. Thanks in advance. Most of the idea, comment, information, and criticism containing in these videos have been created by Daily News Report. Before making any important investment decision, use the information contained in these videos as a starting point for conducting your own research. If you make any investment or legal decision, it is advised to consult an expert before making this decision.